going. So I'll be doing this week's news, and then I'm going to hand over to Richard Williams, who's going to be talking to our guest this week, who's Paul Bridge of Civitas Social Housing. So in terms of news, I think the thing that sort of dominated my thinking this week has been the windfall taxes, or whatever we're calling them. But we also got a bit of fundraising news that I thought is actually kind of relevant, and we should squeeze in at the end. So as we know, oil prices have been soaring. That's the UK oil price. Gas prices have been soaring, and although they've come back, it looks like they've come back quite a long way here. You compare that figure here to where we were this time in 2020, and we are still multiples of the previous gas prices. And carbon prices are going up too, so that affects how much it costs generators to generate electricity. So all of that is driving much higher power prices. And the other thing you should know if you've been reading our notes is that the thing that most drives UK power prices is the national gas price. And that's because when the wind isn't working or the sun's not shining, the marginal producer of power is the gas plant. And it's the marginal producers of power that set the power price. And so higher gas prices just translates into higher power prices. That's just the way it works. So obviously, if you've been extracting and selling oil and gas, and you're getting it from anywhere other than Russia, then the price you suffer has been risen without you incurring any additional cost. So there's a good reason why you've been making supernormal profits. By the same token, if you've been generating energy and you don't have a fuel cost that is affected by this, so it's not gas or in some cases diesel, because diesel is the other thing that is used as peaking plant on some occasions, but it's very sort of minor. You're still earning more for this power than actually it's costing you, so you're making a supernormal profit there too. And obviously we do know that many consumers need help with their fuel bills. And the logic suggests that the funding for that must come from somewhere. So all of that adds up to make sense for windfall taxes. Obviously, the government's dragged their feet over this, and they were ruling it out only a few months ago. And they were ruling it out again only last week. But they said then actually it was because of the way it was designed rather than the logic of the thing in the first place. So the Labour's proposed amendment to the Queen's speech was defeated, and then just a week later, Rishi stood up and announced his new energy profits levy, which of course is not a windfall tax, but an energy profits levy. So the way it's going to work, it's a 25% surcharge on oil and gas sector profits, so just oil and gas sector. He reckons it's going to raise about 5 billion over the next year. The really mad, crazy thing about this, is why I've highlighted it, is that there's an offsetting arrangement to encourage firms to invest in oil and gas extraction in the UK. So they get an investment allowance that gives them 91p tax saving for every pound that they invest in oil and gas, and not in renewables, in oil and gas. And this thing persists for some time. So basically, it'll disappear if oil and gas prices come back to normal levels, which I suppose is probably going to have to wait out the war until I can't see why they'll come down before that. Then it will phase out the levy. But there's also a sunset clause, so it runs until December 2025. So really what we're saying is for the next 3 years, or 3 and a bit years, we are going to be in a situation where oil and gas profits are going to be taxed, but they're going to be encouraged to invest in oil and gas. So the levy does not apply to the electricity generation sector, although we know that they've been making more money than they should have been, perhaps. But the government is still trying to work out whether that makes sense to put some kind of levy on the energy generation sector. But it recognises that it's complicated. So at the moment, we have a sort of hiatus while it says something must be done, but we don't know what it is yet. And I suppose that's casting a bit of a pall over the sector. So, as I've stressed here, there's no incentive for oil and gas funds to invest in renewables, which is a great shame because actually they have been doing that in quite significant numbers, actually. In fact, I think this is an active disincentive for them to do it because the funding for investing in renewables can only come out of tax flows that have been highly taxed. So any sort of oil and gas sector, again, firm is sensibly going to invest as much in oil and gas as it possibly can to minimise its tax bill. And if there's any money left over for renewables, all well and good, but there's no incentive to do that. We haven't had the windfall tax on renewable energy funds ruled out. And if they do bring one in, even if they think about it very carefully as they say they're going to, can we actually trust that they're going to be sensible in the way they introduce that? So I think one of the crucial things for this is, would it recognise that a lot of sales of power are not made at the spot price? So, and that goes for the normal generators as well as renewable generators. So a lot of them have locked in sales of power at lower prices than the spot price, because to give themselves some long-term security. And so therefore they're maybe not earning as much excess profits as they would be otherwise. And so it would be wrong to tax them as though they were. Then the next question really, and the sort of key, I think, to this is, would it give some kind of relief for investment in renewables in the same manner as the oil and gas levy does? And you'd hope that it would do. As I say, it is sort of overshadowing the sector a bit at the moment. I think there's going to be more talk about it as we go through the next couple of weeks. If they decide, oh, it's all too complicated, will they actually make a public statement to remove the uncertainty, or will it just sort of hope they quietly goes away? I'd be hoping that they'd be actually quite clear about what they're up to, but that's not a guarantee. And I think there is that fundamental question there, that even if renewable energy companies in the sector are earning more money than perhaps they should be now, is that the end of the world from a societal point of view if instead of paying those out as dividends, they actually reinvested them into accelerating the pace of developing renewable energy in the UK? I haven't seen any sign yet that renewable energy companies are looking to increase distributions in a sort of an accelerated manner in response to the profits they've been earning recently. Any of these have gone up, but that doesn't mean much really, except in terms of what you can raise money at. So here's the sector as it stands, and that's about sort of £15.5 billion worth of market cap, and well over 10 billion of that is invested in the UK renewable energy sector. We've got more funds trading at discounts than perhaps we would have done before, but within that, there's some of them the usual suspects. So we've got the energy efficiency companies that haven't really invested enough yet, so Nuclear and Triple Point. We've got US Solar, which people have taken against, and we're not quite sure why, but I think maybe they've got one loose shareholder who's pressing the price. We've got Next Energy, and actually Foresight's bounced a bit this week, which is probably encouraging. But Next Energy, there's no real obvious reason why that would be so weak. And as we've written on a number of occasions, it's got a lot of exciting projects going on. It's earning decent cash flows. It's on a huge yield. That to me, that doesn't make any sense at all. So these discounts, the premiums have come down, but we're not seeing much of discounts yet. I'm hoping that we don't see that, but there is some pressure perhaps on the sector. And we know that returns have been very good recently, and that's been driven by the inflation as well as power prices. So what we've seen in the meantime, this week, we saw some modest falls in some share prices, notably things like Greencoat UK Wind. Most worryingly, I think Bluefield Solar felt that it had to delay its fundraising. It only pushed it back a week or so, but I think it's still going to be able to raise what it wants to. It's issuing shares at 130p, which is still a small discount to the 130.5p share price. The absolute disaster would be, as I've said down there, if these funds were unable to raise money while all this uncertainty persists, then we've basically got the oil and gas companies disincentivized from investing in renewables. These funds not able to because they can't raise the cash. So we basically get a complete shuddering halt, just as when we need to accelerate the process of doing this. So we really are sort of shooting ourselves in the foot with this. I suppose it is worth reinforcing the message that the European US funds are not affected by this. So things like REIT and Aquila, they should be okay. And also the energy storage funds obviously not affected by it either. So the whole sector is not hit by this, but the big UK ones, things like Bluefield and Greencoat are. There's the Greencoat UK Wind share price, and you see the big drop that we had when they became obvious that they were talking about levying windfall taxes on renewable energy companies too. Here's the one in Bluefield, same thing, really not quite as marked, but still there nevertheless. Really not great. And I say that it does put this question mark over fundraising across the whole sector, but because I suppose battery storage is unaffected, because we know that there are huge amounts of investment needed in storage as well as renewable energy generation, people have been willing to put up money. We have seen substantial fundraisers over the course of the past couple of years. This one this week has been no exception. So Gresham managed to raise £150 million. It's going to issue 103.5 million shares at 145p. And that issue was significantly oversubscribed, so that actually scaled people back. And that gives them enough finance to almost double the size of the portfolio, which is impressive stuff, really. And we do need this battery storage investment to help stabilise the grid as we add more renewable energy to it. Now, I suppose the other message that I wanted to bring out about this week is that, once again, we've got an issue here which has got away quite handsomely because it's been done at a discount to the prevailing price. But ordinary retail and shareholders were not able to participate. It was done as a placing. It was open and closed within 24 hours. And yes, the money flooded in, and yes, he got the money he wanted, and yes, perhaps that's a cheap way of doing it. But it fundamentally isn't fair to retail investors that they cannot participate in this. And at some point, I'd almost want to see lawyers going after this, because I just don't think that this is the right way to be going about it. We've got a similar situation here with Home REIT, which is a fund that I love, and I think it entirely deserved to raise the money. It managed to issue 263 million, way more than it said it wanted originally. So it's raising it for 150, and even at that level, it was significantly oversubscribed. It's going to put that money to work, funding badly needed new homeless accommodation, and all well and good for that. I think it's a great shame that the company we're going to be talking to in a minute, QuotedData's, which also would love to get on and finance badly needed new accommodation for people with specialist needs, isn't able to do that because of its discount. So fundraising is all good, but once again, the ordinary shareholders weren't able to participate in that. It was just structured as a placing, and that simply isn't good enough, I think, because the money will come, and it just may take a week longer, and it might cost a little bit more for the company, but it is worth doing to level the playing field, I think. There's one question from what I was saying earlier about the windfall taxes, whether it affects JLEN, and it's talking about well, JLEN will be affected by the windfall tax given its big focus on anaerobic digestion. There will be some impact on JLEN because it's got wind and solar too, but the anaerobic digestion, a lot of that is heat, and obviously heat and power are very different things. There is some power generated, but it's a much smaller part of the pie. So actually, the impact on JLEN will be less than it would be on some of the other ones. All right, so that's enough from me. I'm now going to hand over to Richard.